Hey guys, John Paulamy here, Actionable Intelligence. Today's Wednesday, April 18th, 2018. And today I want to introduce you to one of the resources that I use to pick my stocks or investments, speculations. And I think that the principles in this book were written 60 or 70 years ago, but they still apply today. And here's the book. If you can see it, it's by Thomas Phelps. It's called 100 to 1 in the Stock Market. And basically, this Phelps guy was a private investor, author, columnist. He worked for Barron's and the Wall Street Journal. But his career was back in, started in 1927. And he was a reporter and columnist, financial reporter, but he was also a money manager. And he did research into determining how some stocks were able to go up 100 times. So basically, a dollar put into these stocks that he shows in this book created $100 in wealth in 40, 30, 20, sometimes even 10 years. And he goes over 386 of them. He lays it out in the book, but most of them were back in the mid 30s, late 20s, 30s, 40s. But what he demonstrates in here is that there are 100 to 1 shots, 100 baggers throughout history. And I mean, some of the principles that he lays out in this book are, they're pretty, again, they're easy to understand, but they're hard to implement. So I think one of the main gists of this book, and we've talked about it before, and you've heard me say it, but one of the main things he says is, quoted out of the book, to make money in stocks requires 3 things: vision to see them, courage to buy them, and patience to hold them. So that's easy to understand, and it makes sense logically, and I can sit here and pontificate about, find the right stocks and hold them for some period of time, and they'll create wealth. But it kind of is like the Aesop fable of the grasshopper and the ant. I mean, the grasshopper goes to the ant that's been preparing all spring and summer and fall for the oncoming winter. And the grasshopper's been laying around, just laying in the sun, not doing anything. So the grasshopper goes to the ant and says, I've noticed that you've prepared for the winter, and you've got a house here with provisions, and I've done nothing. So do you have any advice for me? Because the days are getting shorter and the temperatures are getting colder. So the ant tells the grasshopper, well, my suggestion to you is to transform yourself into a cockroach and go into that house over there, and then you can live off the warmth and crumbs of the humans living there. So the grasshopper says to the ant, well, how do I become a cockroach? And the ant says, I've given you the main idea. It's for you to figure out the details. So that kind of goes back to, it doesn't really help anybody to say that in order to get 100 to 1 shots in the stock market, that you need the vision to find them, the courage to buy them, and the patience to hold them. That doesn't really help anybody. But later on in the book, he goes into basically 4 categories of stocks that he has found, that he has highlighted, the 4 types of situations that can lead to 100 to 1 shots. And we've went over some of these before, and I'd just like to go over, it's pretty short, I'd like to just read it out of the book. It's the 4 categories are a stock that advances primarily due to recovery from extremely depressed prices at the bottom of the great bear market in history. He's talking about the Great Depression. Special panic or distress situations at other times belong in this group too. So we've seen that, right? I mean, 2008, when the S&P was at 666 or whatever, that was the time to go in and buy stocks. But we've talked about the psychology of why that's difficult for most people, even though that represents an opportune time to go in and buy stocks cheap. So that's what he's talking about there. So that's one opportunity to find 100 to 1 shots. The second is stocks that advance primarily due to change in supply-demand ratio for a basic commodity reflected in a sharply higher commodity price. So again, we can relate that to a modern situation. That's our expectation that we have, like in the oil or uranium market. I have no doubt in my mind that some of the uranium stocks that are out there right now, that as this uranium market recovers, and we see the price of uranium go up 4, 5, 6 times, which I expect to happen over the next 18 to 24 months. As that happens, I have no doubt in my mind that some of these stocks are going to go up 100 times. So that would be an example of that. So the fourth category would be advanced primarily due to great leverage and capital structure in long periods of expanding business and inflation. That would be harder for me to equate to, but that's one of the, I'm trying to think of an example, but I can't off the top of my head. But that would be like, well, let's look at it from a perspective of these companies that do roll-ups. They roll up an industry, they do a lot of mergers and acquisitions, and the stock price continues to go up. So that would be like an example. I don't necessarily get involved in those. I don't like to deal with debt and roll-ups and all that stuff. But I think that would be an example for that methodology, or that for 100 to 1 shot. And the last one was advanced primarily due to the arithmetical result of reinvesting earnings at substantially higher than average rates of return on invested capital. And that is really the main one, guys, of how 100 to 1 shots take place. Let's look at it. You have a business, okay? It's in its infancy, it's growing, it's providing a product or service that people want. This is kind of like the Warren Buffett methodology of buying companies cheap that have a moat, that have a great product, that has a high return on investment in capital, and that the company continuously makes increased profits every year and invests those profits back into the business, and does it over a long period of time. And he gives, like I said, he gives many examples in the book, going back, like I said, this book was written in 1971, and a lot of the examples are from the 1930s, right after the Depression. But there's another guy, and I'll put a link to it in the video notes, a guy named Chris Mayer, who actually turned me on to this book, but he wrote a book also about this, where he went and analyzed using Thomas Phelps methodologies, but looked for stocks in modern times that have done the same thing. And he was able to find several hundred also stocks. So they're out there. And I really suggest that you guys get this book and read it. I mean, it's paperback. You can get it on Amazon. He gives example after example. One of the examples I like is he talks about this coal company in the 30s and how, recently everybody's been talking about coal. It's going out of favor. It's going away. Everybody hates coal. Well, they had that conversation back in the early part of the last century when oil began to become the major source of fuel, and everybody thought coal was going to go away. So the coal stocks crashed because petroleum was going to take over, and then there were some great values there for coal stocks, and some of them went up. He gives examples. I mean, he gives example after example in here of where $10,000 was turned into $1 million, $2 million, $3 million, $11 million. He talks about Eastman Kodak, talks about Xerox, talks about some of these other companies. And then, like I said, he just doesn't leave you hanging like the ant did to the grasshopper and say, well, that's for you to figure out. He actually tells you how to do it and what to look for. And with modern internet and research, it's not hard to find companies that have sufficient returns on invested capital or returns on capital that are compounding over time. So we get back to that old compounding mathematical genius thing that's out there that creates wealth, where you take this year's earnings, reinvest it in the business, creates more earnings, and just keeps going. So the effects of compounding, being able to identify the right stocks, then going in and be able to buy them, and then having the patience to hold them for a long period of time. And these are a lot of concepts that we've talked about before. And I just pulled this book off my bookshelf recently and was rereading it, and I thought it would make a great video because it kind of, these concepts that we've talked about before that allow us to get these higher than average returns. It's not a secret, guys. It's people have done it before. This guy was was in the markets back in the 30s and 40s, and the same psychology, the same ideas, the same BS was going on back then that goes on today. The stage never changes, just the actors. So going back and learning from others, not trying to reinvent the wheel, this is what we're trying to do. And this is what I'm trying to educate you guys. I mean, I know that the demographic watching these videos is fairly young. even just like Twitter or Facebook, I mean, YouTube pretty much can tell me what the demographics are. So I have a male audience primarily in their early 20s to their early 30s. So you guys are just starting out investing, or you're finally got a good, decent job, you're accumulating a little bit of cash, and you're wondering what to do. Guys, don't make the mistake of floundering through and think you're going to figure it out on yourself. It's like Charlie Munger said. Charlie Munger, the partner of Warren Buffett, said. I'm paraphrasing what he said. He basically says, I take the best from the most intelligent people. There's no sense me in reinventing the wheel. No one's that smart. And that's exactly what I'm trying to encourage you guys to do. The effects of compounding take place over years. The most important thing that you have, the most important resource you have is time. You cannot waste it. Okay? You cannot stumble, bum, and fiddle, freak around and waste time trying to figure it out on your own when people have already laid out, these various treasure maps for you. Okay? All you have to do is follow the methodology. All you have to do is follow what's worked before. You don't have to reinvent the wheel. One of the things that Phelps talks about in this book is the idea about short-term trading, or many times that people short-circuited, like he talks about Xerox, and he talks about it was a great company over the years and how it returned multiples on itself, hundreds of times multiples of what original investment. But he says in almost every one of these incidents or examples, how many people actually held throughout the whole time and went from $10,000 to $11 million. How many people were able to have the patience? He chronicles a old investor. He gives an example. One of the first chapters talks about an old investor that came in with his son to this investment advisor, and he was going to transfer the assets to his son. He was getting old. He knew he was going to eventually die, and he wanted to have a good transition to his son. And when they first were talking with this advisor, they were kind of feeling him out. They wanted to make sure that he was the right guy to handle the accounts and everything. And when they were meeting, the advisor asked this wealthy investor, give me the amount you're talking about. Well, first he gave him one amount, then in the second meeting it went up a little bit more, and it was like $5 million at the first. My assets are $5 million. Then he became to trust him more. Well, they're really like $7 million, and then finally it came out that really I have like $15 million. And the advisor was shocked. He goes, how did you get these returns? I mean, all through the Depression and all the stuff that happened in World War II. And he said, I never sold anything. So he bought cheap, and he said he never sold anything. So, Phelps makes the example that you could take a dart and just throw it at the financial pages, pick 100 stocks, and at least one of them would go up 100 times, and that would make the profits for all the other ones that did bad. So we've talked about these concepts before, guys. Time is your best asset. I don't care if you got a house or whatever. Your best asset, if you're a young man or a young person, is time. And understanding the concept of compounding. Picking the stocks, finding the companies and the stocks. That's the easy part, guys. It's how do we maximize the return? And these old timers have laid it out for us. So I'm going to put a link to this book in the show notes, and also to the Chris Mayer book that's more updated with examples. He has examples in his book like about Monster energy drinks and stuff like that. But these things are out there, and I'm going to be highlighting. I've been doing a lot of these in the paid newsletter. We have some good situations on the free portfolio. We've got a couple situations, but I'm also going to be not just looking for these commodity type things that are turning around, which I think can give us excellent 10-to-1. 5-to-1, 5-baggers or 10-baggers, but I'm also looking, I'll give you an example off the top of my head. I like investing in frontier markets that are growing, that have positive demographics. What am I talking about? India, Vietnam, Myanmar, okay? Let's take a country like India, for example. Right now, the country is growing at about 7 to 8% a year. They don't really have to do anything except for continue to build roads and get the place electrified, and productivity in the country will be sufficient. Productivity increases will be sufficient, okay, for the economy to grow 6 to 8% a year for decades, okay? Same thing in Burma. You go to Burma or Myanmar, it's just opened up 5 years ago. It's starting at a very low base. And there's a company there that trades in Singapore that has their finger in a lot of different businesses in Myanmar. So the economy in Myanmar is growing at about 5.5–6% a year. And there's a tremendous amount of upside there because nothing really has to happen except for, like I said, build more roads and get 100% electrification. Just the productivity gains from that will be sufficient for the economy to grow. So you can put $10,000 or $20,000 into one of these countries, or there's vehicles you can use. You don't have to directly invest. You can direct through this, like in Myanmar, Yoma Strategic Holdings, which I'm going to write an article about and do another video about. But that's something you just buy and put in a coffee can and bury it in the backyard, then dig it up in 20 years, and it's going to be worth a lot more. It's probably going to be 100 to 1 shot. It's the same thing in India. You don't have to go to India and figure it out. You just buy Fairfax India, that's run by Prem Watsa, and let him do all that work for you. So I'm going to highlight that stuff because these concepts do work, guys. And if you have the time to let your capital compound, if you have 10, 15, 20 years and you're in the right place where compounding can have its effect, you can have millions of dollars with a very small investment. The question is do you have the patience? Do you get it? Okay? Do you understand the concepts? Will you accept them? Will your mind allow you to accept them, or will you get sucked into the news? Well, the stock market looks like this is all irrelevant. Okay? Think long term. So we have some short-term things that we think are going to work in the commodity markets. I really want to start focusing on some of these longer-term things. It works, guys. It works. It's documented all throughout all economic times, through a depression, through World War. These concepts worked, and there's nothing that bad going on nowadays. So that's the video for this week. I mean, it might have been a little bit jumbled. I hope you got the concept. Let me know in the comments if I need to explain a little bit better. You should see a little bit better video quality. I'm using a better camera now and a better microphone, so I'm hoping that the video quality is improving. Like I said, I really appreciate the comments. I really enjoy interacting with you guys, so feel free to ask more questions. Comments are good or bad. And I really appreciate you guys watching and subscribing and paying attention to what I'm trying to do here. So thanks a lot, and we'll talk to you next week.